Hello, in this video we will be discussing how to exit your trades. Traders who frequently neglect to set up an exit strategy are at greater risk of incurring losses. Those who exit trades in a strategic way have a higher chance of securing profits, even in difficult market conditions. Online trading platforms with their tools and indicators help traders to understand the market better and the potential direction of price movements. Exit strategies that anticipate end of trends or limit losses are most helpful in these markets. Two factors to keep in mind before settling for a particular exit strategy are how volatile are the markets. Significant price changes need to be approached with extreme caution no matter what's causing them. Risk appetite. The risk-reward ratio is important. How much capital do you have and how much can you afford to lose? Exit strategies to consider are pivot points. Pivot points are a great way to predict support and resistance levels, which in turn help traders to figure out when they should enter and exit a trade. Volatility stop loss. Professional traders use volatility stops which adapt to changing market conditions. Time-based stops can also prevent you from being exposed to unforeseen trading scenarios. Trailing stops. Trailing stops can be changed over time depending on price movements. Using moving averages for stops. Traders continue to set new stop losses on a revised basis throughout the trade, depending on where the price is in relation to the moving average. Scaling out strategy. Scaling out is when a trader will sell a fraction of their total exposure after the position becomes profitable, locking in some profit and leaving other positions open to benefit from price advances. A profitable position can be exited all at once or by breaking it into portions to take advantage of favourable short-term conditions.